Hey everybody, I'm really excited to be here tonight. I want to talk to you about dividend stocks. Dividend stocks are one of my most passive income streams that I have, bar none. I want to just start off by saying that that finger is the index finger. So I know that it looks a little weird. I get it, but let's have some fun tonight. Uh, why are you here? There could be a number of different reasons. Maybe you've heard about dividend stocks and you want to learn a little bit more. You could be a beginner, right? Or maybe you already know about dividend stocks, but you just don't know how to choose dividend stocks. Which ones do you choose? We're going to talk about that tonight. Maybe you already own dividend stocks, but you don't know where to buy them and you don't know where to sell them. That's a very common issue. And we'll talk about how you can decide where to buy and sell your stocks. Maybe you're a dividend pro. You just think, hey, I could always use a few more tips and we can go from there. The last reason that you might be here is that it really is hot outside. It's a little hot in here, to be honest with you. And maybe you just want to see what this is all about. So let's get started. I think the best way to get started is for me to explain who I am. If you don't know me, my name's Justin. I've been a stock investor for over 25 years. I've been an active stock trader for more than 15 years. I was a liquid millionaire by the time I was 40, and most of that is attributed to the stock market. I bought Google at the IPO, and I still own most of the shares that I got from Google, and it split to Google. And I love that we had a 20-to-1 split. I'm able to sell so many covered calls on Google. It's just a great way to generate a different kind of income that we'll talk about next month. But I quit my corporate career job about 3 years ago because I made so much money from passive income streams, including the stock market, that there was just no reason to stay at my corporate job anymore. Like I said, the stock market is the main source of my income, and I created Good Kids Trading. Just a fun fact about me is I really need vitamin C. As you can see, this picture was from last week. I was at the beach. I just have to have the ocean air, the salt water. It's just something I need. I know that stocks can make you have the freedom that I have because stocks are my passion. They are my expertise. And let's jump in to talk about what you can do. And quick commercial break, sorry. But Good Kids Trading is the community that I've started. I just brought it up a second ago. I have a really cool blog post here. I'm giving you all the secrets that I wish I knew when I started out. We have a Discord community. Feel free to visit us. Goodkidstrading.com, the blog. You can click on join our Discord. There's lots of good trades here. We can make a difference in your life. We can help you learn how to use the stock market in a responsible way. So that's going to be the only sales pitch you get for tonight. I think that it's going to be a good opportunity for you to check our site out. Today, you're going to learn several things. And I want to tell you that we're going to talk about the power of dividends, the power of passive income. We're going to talk about why you need a diversified portfolio. Everyone needs a diversified portfolio. You don't need to just be in dividend stocks. You don't need to just have ETFs. You can build a diversified portfolio. We're going to talk about it tonight. Another thing that we'll talk about is stock selection. We're going to talk about easy ways to decide when to buy and sell. We'll talk about how to double or even triple your dividends. If a company pays a dividend, we're going to talk about how you can increase your dividend pay. We're going to look in that really closely. We're also going to talk about hedging and managing your risk, setting some realistic expectations, and I think it's going to be a great night. I asked Copilot, I was like, hey, Copilot, create an image for my presentation to show people they can make money in their sleep. And so AI apparently thinks that after this presentation, you're going to have a bedspread of, I'm hoping those are $100 bills. They're the old style, but that's what's going to happen tonight. We're going to talk, well, at least Copilot AI thinks that after this presentation, you're going to have a bedspread of $100 bills because you are making money in your sleep. I just thought that was fun. I added in here. There's another Copilot image. We'll talk about it in just a few minutes. I think you'll enjoy that as well. But for real, my goal today is to teach you my best information about dividend stocks so you can make smart decisions as you move forward building passive income. And I think the best thing to do, because I've talked to enough people, I know the most common roadblocks that get in your way. So I want to start with some myths. I think the first myth that I always get from everyone is, I don't have enough money. Justin, you have this huge account. I understand you're retired from dividends or partially from dividends. My account's small. I don't have that kind of money. I can't invest in dividend stocks. I can't even invest in the stock market because I just don't have the money. And I want to tell you a quick story. So when I was 18 years old, right, fresh out of high school, I thought I'm going to just take a year off. I'm going to go to the beach. I'll be in the boats. I can go fishing every day, go to the beach. I had no idea what I was going to do. Just take a little time off, enjoy some vacation time for a little while, just try to find my direction. And my dad had a different option for me. And his option looked a lot like this. A commercial plumbing company. And he said, hey, son, you're coming to work for me. And I, I was thinking, hey, no problem. Sounds great to me. As I look at this picture, like I see the pressure gauge there, and I kind of have flashbacks and cold sweats of thinking about leak tests, and I hope there's not a leak there. But I was like, oh, sure, Dad, no problem. Come work for you. I'm like, how bad can it be? We're just gonna put some pipes in the ground. We'll once the slab gets poured, we'll fix up all the toilets and the fixtures, and can't be that bad, right? And I was like, hey, Dad, so when I start next week, do I get to use the backhoe? Like, I mean, that's the best way to dig the ditches, right? Like, you use the backhoe. And he says, no, no, son, I operate the backhoe. He said, I've been doing this for 40 years. He's like, here's what you get. You get a shovel. You don't start with the backhoe, you start with the shovel. I was like, man, this really sucks. I mean, I don't know about you guys where you live, but like if you're in Alabama and you're digging ditches and shoveling, uh, see this guy, like I don't know this guy, but I know this guy because I was doing this in Alabama in August, and it was hot and it was horrible. And after 9 months of doing something that looked a lot like this, I was like, get me out of here. Where do I sign up for college? But I want to turn this back into stocks and not having enough money, because what I didn't realize at the time was this shovel is the perfect analogy of getting started with trading, investing, anything. Because what can you do with this shovel? You move like one shovel full of dirt, right? What do you do with this backhoe? Let me tell you, when you jump on that machine, like if my dad said, hey, sure, son, jump on that backhoe, have at it. Can you imagine OSHA insurance aside, okay? Can you imagine the amount of damage I could do with that backhoe? In the stock market, could you imagine if you had $1 million and you didn't know what you were doing, you just threw it all in one random stock because someone told you about it? I think that I would have destroyed more than I would have fixed. Like point A to point B, it wouldn't have happened. So how much damage can a machine do versus how much can a shovel do, right? I think that what we think about is we think I only have a shovel to invest. But at the same time, you want that shovel, because I'm going to tell you right now, it's not about the money that you have. It's about getting started. You just need to get started. You need to start small. And the reason you need to start small is because when you start small, the money means more to you. That shovel full of dirt, it means a lot more to you than moving that backhoe that you think you want so bad. So I think that the biggest mistake traders make is they say, I don't have enough money, when that's actually to your advantage, because it's going to make you work so much harder to learn to invest and trade the right way. The next myth that I hear all the time, not just about dividends, but the stock market in general, is I don't have enough time. They're like, I don't have enough time. And I'm going to tell you right now, I get it. And they're like, no, you don't. You're retired. You don't understand. And I'm going to tell you, I asked my next co-pilot image, okay? And I had to use this because, I mean, guys, look at this guy's hair. Look at my hair. Okay, I actually did kind of brush it and get it like styled tonight, but co-pilot knows me. I was like, co-pilot, create me an image of a stressed out Justin sitting at his desk. Because I'm going to tell you, I spent 20 years working in corporate America. I worked nights, I worked weekends, I was in healthcare. So I worked on holidays, Christmas, birthdays. It didn't matter. I had two cell phones. I had a cell phone here and a cell phone here, a work phone and a personal phone. And I carried that work phone around like sometimes I still look for that work phone. And I'm so glad I don't have to have it anymore. But I understand how people don't have time. I really get it. You can't tell me I don't because I spent 20 years doing this kind of work. And this is way nicer than my office. We didn't have plants, and this is just really nice. I mean, look at this mouse. We had a mouse with balls in it. I don't know. Um, I get how stressful work can be, and for me, that's all the more reason to learn dividend investing and stock investing because I want to stop living the life of stress in a cubicle. And you should too. And you're like, I don't have time. Well, I bet you're sitting on Netflix. I bet you're on Instagram. I bet you're on Pinterest, TikTok, you name it. I bet you're spending time on your cell phone when you could be spending 5 minutes a day for 5 days a week, which is 25 minutes a week, right? 5 days, 5 minutes, 25 minutes a week. That's 60 hours a year. If you spent 60 hours a year learning about investing, learning about anything, you're going to be way better than you would be scrolling on Instagram, looking at all these videos that are mostly fake. And I'm not even going to talk about if you spent 30 minutes a day learning. What if you spent 30 minutes a day, 5 days a week? What if you spent 30 minutes a day, 6 days a week? What if you went and spent 30 minutes a day every single day learning to trade the stock market? I'll tell you right now, I trade the market for 30 minutes a day. It is my main source of income. But keep in mind, just like my dad with the plumbing company, he had operated a backhoe for 40 years. He knows how to lay the pipe from point A to point B, right? The most efficient way. He knows to watch out for the gas lines, to avoid the underground power. Hey, go get the line locators out there. He knows all the tricks. So I'm not telling you that you're going to be able to operate the backhoe or you're going to be able to trade in 30 minutes a day, but I am saying you can find 5 to 10 minutes a day to not Netflix and chill, which is like way more than 5 minutes, or to sit on Instagram, TikTok, etc. I know a lot of people say, hey, I'm not smart enough. Justin, the stock market's too hard. I'm not smart enough. I can't do this. Well, let me tell you right now, this is me in a stock image because it's not really me, but I was born with dyslexia. And I don't talk about it a lot. I don't really think about it, but I struggle with reading. I struggled with schoolwork all my life. And when somebody was like, hey, you need to learn math based options, like I started breaking out in cold sweats because I'll tell you right now, when I was in school, I you see all this math and all these different crazy like these formulas up here that just don't make sense and like imaginary numbers. I don't know. Maybe you're a rocket scientist, maybe you're not. I don't know, but I struggled with math and my professor in college felt so bad for me. He's like, "You know what? A D is passing and you're getting a D." And he pointed at this brick wall and he's like, "Hey, you see this brick wall right here?" He's like, "Everybody's going to hit a brick wall. There is only so much you can figure out at once." But you know, the best part about it is that what we are doing here is we are sticking to math that you can do on a basic calculator. And I'll tell you right now, like I have my calculator right here. Like I have it on my desk because I use it. So when people say the stock market feels like gibberish, I get it. Like D's and B's feel backwards to me, right? So I totally understand when my college professor explained to me that it's okay, you don't understand how to take the second derivative of imaginary numbers, which I don't even know what an imaginary number is. Felt okay about it. So, anyways, I don't want to hear that you're not smart enough because I am just as dumb as you are. I promise. I'm not the smartest guy in the room. I don't even pretend to be. I'm not even worried about it. But if I can do it, you can do it. Dividend, the myth number 4. Dividends are small. They're just pennies. Like, how are you going to make money in the stock market with dividends, right? They're small. Let me tell you about this guy named Warren Buffett. Warren Buffett made $736 million on Coca-Cola last month. I'm sorry, last year. $736 million on his 400 million shares of Coca-Cola. So I understand we're talking about the GOAT, right? But, um, what is really cool is that the dividend went up this year. So he's actually going to make even more money on Coca-Cola this year, which is really cool because I know we're not the GOAT. I know we're not going to be Warren Buffett, but if it's good enough for Warren, it should be good enough for us, right? That's the way I look at it. And I want to talk about the rate of return on small investments. I don't know if you know about the rule of 72, but it's a very simple math formula. But, money appreciates pretty nicely as you go up. And over 20 or 30 years, 40 years, like, look what happens to rates of returns. So the more money you can get on your dividends, the better off you are. I'm going to tell you right now, I think a lot of you guys already know this, but the days are long, but the years are really short. Before you know it, you're at a job for 20 years. Before you know it, you've been investing in the stock market for 25 years. You don't even know where the time goes. So just think about it. The numbers, they add up quickly. Like 1,000 goes to 10. And I mean, who makes 12% on the dividends? Not that many people, but it does add up over time. The dividend myth number 5 is that dividends are fake. I had this coach one time, and he's like, Justin, dividends are fake, bro. Like, I don't understand how you're even investing in this because the stock drops by the amount of the dividend. And I'm like, yeah, I know that happens. That's true. Like, he's not lying. The stock does drop by the amount of the dividend. But let's look at 2 examples. I want to start with Coca-Cola, right? We just talked about our buddy Warren, right? So look here, I have the dividends kind of highlighted in green, okay? So the dividend was paid right here. And do you notice the stock opened below? And look at this lightsaber of a green candle that got put in on right on the day of the dividend. Like, how nice is, or I'm sorry, the day right after the dividend. So we got down, dividend, got paid your 43 cents, 46 cents. And then look at this appreciation. Same thing here, dividend, we got down, really pretty, right? Dividend, we actually, hey, what happened here, guys? Like, dividend, we gapped up. We gapped up. How did that happen? But I don't want to say that this always works this way. So let's look at an example where it doesn't work exactly the way that we're talking about. Let's look at General Mills. Dividend right here, gap down. We got down. And look, we kept going down. We kept going down, right? And we recovered, like you recovered. These are daily candles, as you can see right here. So I don't know, like a month later, we recovered pretty decently. And we kept going up, but look what happened. Stock went way down. Stock kept going down. I don't have the rest of this chart, but just imagine the stock just kept going down. So this is a risk. But if you notice, I have some purple lines on the screen here, and we're going to talk about these purple lines in just a few minutes because they're really important to understand how to protect yourself. But I did want to say, dividends are not fake, but they do drop by the stock price does drop by the amount of the dividend. But as you can see with Coke, a lot of times it just comes right back, or even with General Mills, it came back here, and you would be fine if you invested in General Mills. Like, I know you can't see the actual Y and X axes, but we're not talking about huge amounts of money here, but these purple lines are going to mean something to you. You'll see in just a few minutes. There are 2 different kinds of stocks. And I like to kind of add this little extra in there because I like to just think of income stocks. I like to think about income, right? I'm semi-retired, I guess. So I like to think about income. But you have growth stocks and you have value stocks. Okay. I like to kind of group value and income together. There's a slight difference in my mind with them, but we won't go into that tonight. But I stole this from the Motley Fool, giving them total credit. I just saw it on the website. It made a lot of sense to me because many trading groups are going to tell you, hey, growth stocks are the way to go. We're not really worried about income. We want to triple our account. We want to double our account. And growth stocks are great for if you don't care about income, you're comfortable with big price moves, and you think you can pick out some winners. And you also really want to have your time horizon needs to be pretty far out there because, if you're wrong, you have to hold that growth stock for a while. Value investing, pretty much, it's not exactly the opposite because I believe, and I'm going to show you how I look for a lot of the things I look in growth stocks in my income stocks, my dividend stocks. But if you want income, you're not going to get that over here in this growth world. Like I know that Meta and Nvidia and even Google, right? They've announced some really small dividends. So they kind of are in the growth world, but they're kind of moving over to the value world, right? And we'll talk about that in just a second because I think everyone's portfolio needs to have diversification. And you might not like this. I think that every portfolio should have growth stocks, they should have income stocks, and they should have ETFs. And that's right, I said it. Every investor, trader should have ETFs. And personally, I believe your largest portfolio, your largest position in your portfolio should be the SPY. And I know that's not popular. I know that's not sexy, but the SPY is the top 500 companies in the United States. And I think that SPY has a lot of benefits. I personally, my IRA is mostly SPY. I've been in the stock market for over 35 years. You can do the math. Go look at the charts. Look at where SPY was 35 years ago. Look at where it is now. I think you'll be pleasantly surprised. I know I'm very happy with my IRA being mostly in SPY, especially since we just hit all-time highs not too long ago. And I know a guy who was selling some covered calls. So I think there's a lot of benefits in having growth, income, and ETFs. Let's just jump one more time into a little bit of the differences with growth and value. And then we'll talk about a little bit more diversification because I think this is really pretty cool. Growth stocks, the price to earnings are usually pretty high because the companies and investors in companies need a reason to invest in their company, right? So for growth stocks, they're going to give you an extra premium for projected growth. So if your company's growing, Wall Street it's a forward looking instrument, right? We are actually, when we buy a stock, we are actually investing 2 years from now. We're not just investing in what Google's doing today or what is Amazon doing today. We're investing 2 years from now. So what you're paying for in the stock price with growth stocks is you're paying for growth. You're paying for a higher price to earnings. They better be growing. They better be making really good earnings. They're usually younger companies. They have high revenue. They have high volatility. I put a little asterisk here beside dividends because, like I said, some of them are starting to pay really small dividends, but for the most part, growth stocks do not pay dividends because they have the growth. So investors are like, hey, I love when my stock goes up in price. I do too. The optimum market for growth stocks is bull markets, expansion in the economy. Love it. Very aggressive risk profile, right? If you're in growth stocks, it's aggressive. Now for value and income, the price to earnings is lower, right? So if you have lower growth, you have lower earnings, what's going to make you want to invest in that company? Why would you invest in Coca-Cola if they're growing slow? Why do you want AT&T if it's growing slow? I wish I didn't even put Intel on this list, but let's skip. Why do you want Procter and Gamble if it's growing slower? I need something to like entice me to get into a value. And that's right here. Dividends are the enticement that you need or investors need to invest in a lower to moderate earning company. These are old companies. Their revenues just kind of, like I said, moderate. They're boring. These are boring stocks for the most part. Low volatility. They work really good in bear markets or recessions. They have a conservative risk profile. So what happens is you're paying for earnings or you're getting paid for dividends. And there's a lot of differences between these companies, right? Let's talk about diversification because even within these, I believe you should have a few of these, you should have a few of these, and perhaps you should have a few ETFs. So it's kind of funny because more isn't always better. Like I want to be really clear about this. You're probably not looking to run a mutual fund. You probably don't need 75 companies in your portfolio. I'll tell you a quick story. I know that it's a little funny, but one of my last mentors, he looked at my portfolio and like I'm not even joking. I had like 60 dividend stocks, I guess it was, and he was a little overwhelmed to say the least. And he's like, "Hey, Justin, like I really think you could dump a couple dozen of these positions." He's like, maybe you can even get rid of 3 dozen. Like, drop down drop down like 30 stocks. You don't need 72 stocks. And there was a lot of truth to that because more isn't always better if you can't manage all the positions. So, if you have like AT&T, Coca-Cola, and Procter and Gamble, that's cool. But what if you have like AT&T, General Mills, Pepsi, just keep going, right? You have like Nucor, Devon Energy. You have all these stocks to keep up with. You need a system. So don't always assume you need 12 stocks, you need 20 stocks. Sometimes you only need 3. And sometimes, if you have 3 dividends, you have 3 growth, then you have 3 ETFs, then you have 9, right? So you can just think of it that way. Just don't always think that you need huge diversification. Just don't put all your eggs in one basket. I think that's the main key. I use stock screeners to kind of get a better idea of a company's financials. And I think this is going to help us with that slide that I had a few minutes ago, because I like to look at the price to earnings. We kind of talked about, hey, these income or value stocks, they have lower price to earnings. The 4 PE is something I look at as well. I just want to see, hey, does it have income? Like Procter and Gamble was paying like 2.37%. You say, oh, that's not a lie, right? But like you can look at their debt to equity, earnings per share is another number I look at a lot, and return on investment, return on equity, profit margin. These are some of the key factors key metrics I look at. And I use FinViz for the most part, finviz.com. I'm not getting paid for any of this. There's not a fee for this right here to get these numbers. Koifin is a new screener on the market. They do a lot more things than FinViz does. They also charge. And I've looked in some of the free trials. I just don't use this enough because I kind of know the companies. After you do this for a long time, you kind of know the dividend yields, you kind of know the income, the price to earnings, you kind of get it. But let's look at 2 really interesting stocks. And I think this will help us kind of determine what's going on with perhaps Tesla, because Tesla is a growth stock and Nvidia is a growth stock, right? And these kind of both are breaking a little bit of the trend because, as you see, Nvidia actually pays a dividend, although it be a tiny 0.02% of a dividend of 17 cents. I mean, the stock is like $800, right? But that's a little unusual for for growth companies to pay dividends. But let's look at like Tesla, okay? Tesla has a PE of 43. Nvidia has a PE of 73. Like you can't compare price PE multiples for different industries. It's not really fair. But we could look at Ford versus Tesla, and you're going to see that Ford has like a PE of 13, something like that, versus 43. Because you know why we're paying for more for Tesla? It's a growth company. Well, it was a growth company, because I want you to look like the income is dropping, right? The earnings per share is dropping. The price to sales is dropping. All these numbers, like their profit margins are 14%. You look down at Nvidia and you have a high PE, but you have a high ROI, you have a high EPS, you have really big income. Like these numbers are huge, right? Like 30 billion. Once a company starts getting huge, like the law of large averages starts working against you. But just take a look at the companies and kind of get an idea. You want to use sectors to your advantage. We'll talk about sectors in just a few minutes, because you want to get a good idea of, is this company currently undervalued or overvalued? The best way to do that is using stock screeners. When it comes to picking dividend stocks, this is how I used to pick dividend stocks. I'm sort of joking, I'm sort of not, but just blindfold it, throw it at the dartboard, wherever it lands, that's where you go with your dividend stock. Like That's almost what you do if you don't think about looking at FinBiz, right? And then I was like, well, I don't think that's a really good idea. The next way I'll pick my my best dividend stocks is I'll just go to Google and I'll type in highest yielding dividend stocks today, or maybe even highest yielding dividend stocks, and just say I'm feeling lucky, and I'll just put all my money in the highest yielding dividend stock. I mean, you saw the chart, right? You saw that chart. If it pays 15%, then I'm going to make the most money, right? I mean, 15% yield. What could go wrong? Like, this is the best way to invest in dividend stocks, right? It has to be. No. You don't want to chase the yield. You know why you don't want to chase the yield? I have a picture. A picture's worth 1,000 words, right? You don't want to chase dividend yields because have you ever like tried to clean up the house, and instead of cleaning up the house, you just like swept it all under the rug and ignored it? House is clean, like, but what's under the rug? Right? What's under the rug here is, hey, I'm paying you 15% dividend yield. Look over here, but don't look at the debt that my company has, or don't look at our growth that we don't have. So don't chase the highest yields. That's not the best way. Like, I'll tell you right now, I have a couple speculative dividend plays that do pay a great yield, but that's not the answer. What I like to do is another Copilot image for us. I was like, hey, Copilot, what does a dividend aristocrat look like? And this is what it gave me. I thought, hey, maybe that is a dividend aristocrat, right? Maybe that is a dividend king. But dividend aristocrats, they're here in this circle, and dividend kings are kind of in this square. And what I like to do when I first started out was I looked for companies like a dividend aristocrat. And if you don't know what a dividend aristocrat is, dividend aristocrats have consistently raised their dividend for the last 25 years. Dividend kings, on the other hand, have consistently raised their dividend for 50 plus years. So these companies have a history of paying not only a dividend, but raising the dividend. So I think that these are great companies to start thinking about. What companies do I want to have dividend? What are my value companies? These are great companies. I've traded and owned all of these. It's so funny to look at. But the next step that I do once I get this list of dividend stocks, which we'll talk about in just a second, is I'm going to look for the best stock in each sector. And you might be asking yourself, hey, Justin, how do I find dividend aristocrats, first of all? And I don't even know like basic materials and energy stocks. Like, I don't know the difference between any of them. You're showing me all these charts with different sectors, and there's sectors within the sectors. And I don't know what any of this means. Hey, I got you. I promise. There are so many websites out there. Like, I don't even know who this person is, but hedgefollow.com has all the dividend aristocrats listed for you. And look, they even go by sector. So you can sit here and go, hey, Leggett and Platt, Amcor, Kenview. Once again, I've traded, like, I know all these stocks in and out. Like, I can't wait to talk to you about this stock in just a second, because it's paying 10%, guys. This stock's paying 10%. Like, this is the one you need to be in, right? It's on the first on the list. So I don't know this website. Just Google it. Do not pay for the dividend aristocrats. I had some friends who were paying for dividend aristocrats. I'm like, why are you doing that? It's free. But I like this site. I think this is cool that they go by sector. If you don't know the sectors, that's really neat. I did this a lot harder. You won't even believe how I had to do things way before all these websites existed. It involved a lot of spreadsheets and pivot tables and things that just were not fun to deal with. Even the NASDAQ.com has like list of dividend aristocrats. And I did what every investor does, right? I look by yield. I'm like, hey man, I'm just going to invest in Leg, T, M&M, 3M, and Walgreens. I just so you know, I don't actually invest in. Well, I might have just picked up a little bit of this one, but I don't invest in any of these, to be honest with you. And let's talk about why. Because like Leg and Platt, I've invested in this company for many, many years, and they pay a 10% dividend. Everybody needs to be in this. This is Leg and Platt. Leggett and Platt, right? So they pay this nice 10% dividend, and the shares are down 53%. So let's say you make 10% on the dividend, you lost 53% on share appreciation. That means I am up. Oh, no, 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 no. I'm down 43% on my shares. That's great, great, huh? Right? That's why you don't chase dividend yields. But I know a guy who might have just picked up a little tiny bit right down here because the stock is kind of beat up, and I'm going to take a little chance of earnings. But I wouldn't admit that to anybody else, but I'll admit it right here to the world on this webinar. Um, be careful when you chase these high dividend yields. If this is like 1/10 of your portfolio, cool. But if you chase this dividend, you'd be down 40%, and that's not the way to trade. It really isn't. What I encourage all of you to do is go out there and build some watch lists. I use tradingview.com. I like it, not getting paid. I actually pay for the service. Um, I have multiple dividend investing watch lists. Some are separated by sectors. Some are actually just exactly the dividend stocks. But go out there, find the dividend kings, find the dividend aristocrats, and add them to your watch list. That's your first step. And then your next step is, where do you like I've talked to you about looking at the stock screeners, right? Looking at the yields, trying to find some higher yields, find some lower yields, find companies you like. But where do you buy them? Where do you sell them? Well, it's really easy. You just buy low and you sell high, right? I mean, buy low, sell high, buy low, sell high. This sounds so easy. Like everybody says, oh, I buy low, I sell high. Well, I'm going to tell you, when the stock drops low, no one wants to buy it, because what if it goes lower, right? And you're like, well, do I sell here? I mean, what if it keeps going higher? So it sounds easy. I think you need a system. I'll show you my system. My system is support and resistance. I'm going to buy at support. I'm going to sell at resistance. If it drops below support, I have to make a decision. Do I get out? Do I get in? Let me show you an example. I think pictures are worth 1,000 words. Let's look at this chart here. This is every one of these candles you see is a monthly candle, right? Because this goes all the way back to 2018. So I like to think of support and resistance as zones. I really do. I think there's not like a one single line in the sand where stock's gonna stop or go. So think of it in terms of support zones. Like in here, you see lots of little wicks. You see like all these wicks right here where it stopped, and you see all these wicks. So we ran up, right? We hit a top. We came right back down. We chopped around here for a little while. We came back down. We chopped around here. We came back up, and look, we're right back where we were. And do you see the resistance that we keep seeing here? So what I like to do is I like to go to the chart. This is the same chart, exact same chart. I like to put purple lines, and the lines don't have to be perfect. Don't think your lines have to be perfect. Just keep in your mind, hey, I know what purple lines mean. I've been doing this forever. I know what these purple lines mean. These become my targets. And these work. Like I draw these lines, and they work over and over again. You see, we hit here, we hit a new high here, and this person, the person who did not sell here, is like, they watched it go all the way back down, and like, you know what? If it ever hits here again, I'm gonna sell. And so what they do is it comes here and hits here, and this person right here going, I wish I sold last time. They're selling this time, right? And same thing here is when the stock's up here. I wish I bought this stock down here. You know, gosh, when it was this price, I would have bought it. So it comes back down, and they're buying it up because they're like, I didn't get in when it was up here. I want to get in while it's down here. So support and resistance has worked for me for many years. Does it work all the time? Absolutely not. But when you start combining support and resistance with these moving averages, like the blue line here is the 100 moving average. So what it does is it takes roughly, I'm going to put this in very simple terms, but it just takes the last 100 candles, and it gives you the average of the price, right? So eventually, this blue line and the stock is going to meet, because it's just averaging it out. So as the stock continues to go higher, the blue line is going to continue to go higher. This red line is a 200 moving average. So it takes 200 of these candles, and it's like, these are months, right? So like, this is 100 months of previous months of this candle. Like this is the average price. So you can kind of look here and say, hey, moving average, this is kind of where it is. Would I be buying a stock when it hits my upper purple line and it's extended off of 100 moving average or the 200 moving average? No. But do you know where I would buy this stock? I mean, do you have an idea where you would buy this stock? I have a purple line here. I have a blue line and a red line here. This is my buy zone for this particular stock. It doesn't even, I don't even have to tell you what the stock is. I don't have to know what the stock is. I can look at this in 3 seconds and go, I would buy it here and I would sell it here. It's just that simple. And when it comes down to here, I'm definitely buying it. I have a purple line. I just know this is my target. So you draw some lines on your charts. These lines, make sure you put them indefinitely, because I can put these lines on my chart 3 years ago and they still apply today. These lines make a difference. The moving averages automatically do it for you. So it's good to combine support and resistance on the monthly or weekly time frame. Even when you're looking at the daily chart, it matters. Um, I don't have time, Justin. I don't have time. I don't have time to look at the market. I don't either. So I go in and I set alerts on horizontal lines for companies that I like. This is Kraft Heinz. I would love to buy Kraft Heinz if it ever gets down to this level again. Will it? I don't know. I don't even have to look at the chart. I just wait for the alert to hit my email. I get a notification on my app. I'm like, hey, maybe I should go buy some Kraft Heinz. It just hit my line. So know that when you go here and you put your purple lines on, you can set some alerts and you can just set them and forget them. And there's a limited number of alerts that you could set up. So you have to be kind of particular about, you might not want to set up your alerts for, $7 away if the stock only moves, $3 in a year. But for me, I like to set up horizontal alert lines. And when it goes off, I know I'm either buying or I'm selling. When it gets up here, I'll sell it. And you're like, what is that line doing up here? Well, back here somewhere, I saw support and resistance. So like when Kraft Heinz goes from 37 to 41, I would look to get out of this. And yes, I'm in catch up. Okay. I own catch up stocks. I think a lot of you might think, hey, Justin's just making this stuff up. He's telling us all this stuff in hindsight. So I wanted to give you an example of Devon Energy. I know that one of my other admins, Eric, and I were both in this position, and we bought Devon down here. Why did I buy Devon down here? Could it have been because of this purple line? And I actually bought it over here, and it went up, and then it came back down. I'm like, oh, here we go again. But we're around the purple line. All right, so I know that I bought this stock. I posted it in Discord. It might be a little hard to see. I posted it back in I think it was December, and we just got called away, I think last week before last. So we've been in this trade for a little while. We collected one dividend, but what we also did was we sold some premium. I know that I sold covered calls. I actually sold a couple of puts as well, which we can talk about in a few minutes when we get into hedging. But I collected 3 dividends on this stock. It appreciated almost $10, made about $1,000 on this particular trade. Got called away here. I elected to get called away here. I had this purple line. It came up to it. It hit it. It dropped back down. I could have probably rolled it out, but there were earnings. I'm just like, hey, if Devon comes back down to my purple line or it comes back down to these moving averages, I'll get back in. So that's kind of where I am with this. I think it's really easy. It's really good. If you haven't already joined, it's free. You can join our Discord, goodkisstrading.com/join. Have a look. Kind of what I was talking about with Devon. You can use options to create dividends, right? So let's look at General Mills. General Mills has a 59-cent dividend that they paid. Pretty nice. I might be in this one too, just so you know. But this is a cool company. Cereal, kind of boring, but it did kind of break out, came back down. You're like 59 cents every quarter, not too bad, right? But what if you owned 100 shares? What if you bought them kind of off the moving average, right? The blue line with the purple line. What if you bought it down here at 63? Would you be willing to sell your shares at 73? Like I would, I did. I that's $1,000, and I think that a covered call, if you don't know, is one of the safest options trades there are because you have 100 shares of stock and you're selling a call, which basically says, I will let my shares go at $73 and you pay me income, right? So the only risk I have is if General Mills goes to 83 or if it goes to 78 or 74, I'm selling my shares at 73. So I don't get this money. Like I'm not going to make this $800. Okay. But what happens is I come here and I totally get it. If this chart looks like that math chart that I had earlier with the invisible numbers and fake derivatives and all that, I get it. It's really not that hard. I promise. These numbers don't mean anything. But just focus right here. Focus on this 40. So I get paid $40, and as long as General Mills for 20 days stays below $73, I'm collecting $40. And this particular number right here, this POP, is a probability of profit. I don't even have to know the probabilities. The broker tells me that there's a 95% chance this trade is going to make money. 95% chance that I could get out of this for less than I paid, or 93% chance this option expires worthless. That's for 20 days. But hey, what happens if you go out a little bit further? What if you go out for like 55 days? They're going to pay you $60 because it's just like your landlord collecting rent. If you're going to stay in your landlord's, if you're renting, let's say you're paying to rent a house, the longer you stay in the house, the more rent you have to pay. I'm renting my shares out to whoever is on the other side of this. And I'm saying, hey, you can have my shares at $75. Pay me $60. Pay me $60. And if General Mills stays below, let's look at the chart. So if General Mills comes here and it does this, and then it comes back down here and it just does this, and it closes here like in June, I get to keep my shares and I get to keep the money that I already collected immediately right here. So covered calls are a great way to increase your dividend. You can collect extra dividends by selling these however you want. You want to sell them on a weekly basis. You want to sell them on a monthly basis. I just will let you know that dividend stocks pay less premium than a growth stock. And that's because these are less volatile. They move a lot slower. Like look at Tesla's chart and look at General Mills chart. You're not going to see Tesla like range bound between $63 and $66. It's just not going to happen. It is going to happen with boring stocks like General Mills. It's going to happen with value stocks. So I'm saying, hey, if it gets here by June, you can have my shares. If I bought them at 63, I would sell them all day at 75. And you're like, hey, Justin, what do you mean? You're going to, what if it goes to 80? Well, it goes without me because it's above my purple line. You saw it gapped up here and it just came right back down the same day, like on earnings. Is that a shock? No, it's back in its range, right? It just sits in this range. But the longer it sits here and chops around, it will break out eventually. It's going to happen. Another thing that I like to do is instead of just collecting extra dividends on this covered call, I'll come in and I will sell what they call a covered strangle. And a covered strangle is the same thing. I have the covered call here at 73, right? And this is for this is like 20 days away. So hey, if it goes to 73.01, I'm selling my shares. But if General Mills drops unexpectedly, back down into this range, like you see here, I have a 50 EMA. I have a blue line and a red line here. So I'm like, hey, that's not terrible. Like I would buy some more General Mills down here in hopes that I can sell it up here or sell it up here. This is called a strangle. I have 100 shares. So what I'm saying is if General Mills does this, I've agreed to buy some shares at 68. If General Mills does this, I've agreed to sell my shares at 63. This expires worthless. I don't buy this. I just collect the premium that I receive. But if it does this and it stays in between, I just keep my rent that I got from this. I keep my rent that I got from that. And this is what it looks like on the options chain. And what I think is really cool about the options chain, like I understand if this is confusing to you, but Tasty Trade does a really good job of showing you the expected range. Do you see this um, I guess that's a brown ruler like looking. So the expected range, the market makers think that it's going to go between 68 and 73. So when we look at the chart, what did I do? I sold a 68 and I sold a 73. Was that on purpose? Yeah, absolutely. I saw the expected range. I'm like, hey, I'll take this trade all day. It has a 78% chance of being 50% profitable, which would be great. I could collect another dividend. I could get out of this for 20 days. Okay. But what if I go out in time, like we talked about with the landlord? What if I rent out my shares and I rent out my obligation to buy some more shares a little bit further out? So instead of the 68, 73, like instead of getting selling my shares at 73 and buying more at 68, I can go out 55 days and the expected range has moved a little bit, right? So now I can say, hey, instead of buying those shares at 68, I can buy them $50 lower at 67.50, or I can get called away at 75. And I'll collect $1.32, which is $132 in dividends made through options trading. And if this is too complicated for you, I get it. We can talk about it later. We don't have a lot of time. I've already been talking for almost 40 minutes and I don't want to keep you all night. This is a great way to create extra income. You might say, hey, Justin, I think that General Mills is going to pull back. I need protection. Like I don't want to lose my money that I made on this. I'm like, hey, I understand exactly where you're coming from. We're hitting this purple line. What if we do roll over? And what if we come back down to this line? You can set up trades. This is called a super caller. That's what I call a super caller. And so you're still agreeing to sell your calls, you sell your share, your 100 shares at 75. But this particular trade, I like to sell these, meaning I collect rent. And this would actually give me a credit to sell my shares at 70 that I bought at 63. And I have to buy them back at 67.50. I don't have to, but so I sell them here at 70 and I buy them back at 67.50. I saved myself $250 of loss. And I'm going to pick up my shares right back at a moving average and pretty close to the daily moving average, right? This is a 50 EMA. This is the daily 100, the daily 200. So this particular trade is letting my shares go at a high, selling my shares here. So if General Mills pops right here, I've sold my shares and this is going to expire worthless as long as it doesn't come back down to here. If it comes back down to here, sold them here, uh, sold my shares here, I rebought them here, I saved $250, and I collected $1. And I know it doesn't sound like a lot, the market's closed, but sometimes you can get more than $1 of so they paid me $1 to be protected for $250 to the downside and to sell my shares at an all-time high. I think that's pretty cool. With dividends, there is something called a dividend reinvestment plan, or you can elect a payout immediately. So a dividend reinvestment plan is called a drip. Just think of drops of water, drip, drip, drip out of the faucet, right? So a drip is when you reinvest. Let's say you got paid $67 from General Mills. You would buy $67 worth of General Mills stock if you were enrolled in the drip. And you can do this with your broker. Every broker has a different place and a different setting, but you can say, yes, I want to be enrolled in the drip, or no, I want to just have that $67. If you invest in the drip, your money will start growing exponentially because you are taking that free money, I know, free money that you got from the dividend, you're putting back into your shares. So what you're doing is you're reinvesting each time and you're going to benefit from dollar cost averaging, right? Because every time you buy more shares, you're just kind of reducing your average. So you benefit from getting more shares over and over. You could still own taxes. We'll talk about taxes in a while. The downside of a drip is that if you want the cash, if you're retired, like this one guy I know, you might want to just take the payout because you might want to pay some of your bills with the actual dividend. Or, I can decide, I take the payout personally because I can decide, hey, do I want to buy more shares of the company, which I usually don't. But if it's a long-term holding, I encourage you to think about the drip. Think about just reinvesting every dividend into more of the stock. Just keep adding it up, especially if you have a small account. Get up to 100 shares eventually. It'll take some time, but it does happen, right? Another really cool dividend option that I think a lot of people don't think about is master limited partnerships. A master limited partnership is usually oil or gas, right? These are tax advantaged equities. So it's a stock that pays you a higher yield. And I'll tell you right now, it's more, the tax consequences are a little bit different. You actually get a K1, which is something we see on the real estate side of the world, but you get a K1 for any MLPs that you invest in. And MLPs pay really good dividends, 9 to 15%. There's a lot more volatility, and they are very sensitive to rates and interest rate changes. Some stock tickers you can look at if you're interested in at MLPs are EPD, ET, BIP, CQP, and PAA. These I've owned all of these at one time, but just be aware. Like if you trade these, you're going to get a nice dividend, but you're also going to get a K1 about April 5th. I'm not even joking. Like you get it on April 5th. I accidentally filed my taxes, and I was in actually, I think I was in both of these, and I got K1s, and it was just kind of a mess. So if you want to look at master limited partnerships, I think it's a good option. It has some extra tax advantages, and you just need to be aware that you're going to get a K1. That's about it for today. The considerations that I really want you to take away that we haven't brought up is that lower volatility in dividend stocks mean you're going to collect less premium, especially if you're selling options. The dividend stocks generally aren't as lucrative. The options just don't have the juice in them, and you have to know your time frame. You really need a plan based on your time frame. Do you have a max stop loss? Like if you're going to start buying at at support, right? If you're going to buy stock at support and it keeps dropping, what's your plan? Are you going to hold it forever? Are you going to have a line in the sand where you sell your shares and take a loss? I encourage you to. And when do you cut a position, even if it's a loser? I know for me, if there's an accounting irregularity, I'm getting rid of that stock. I'm not going to keep it. There are some tax advantages to dividends. Sometimes dividends are not taxed at all, depending on if they are qualified or not qualified. I'm not a CPA, I'm not an accountant. I encourage you to talk to one, to look it up on your own. But just know that these generally are not taxed at the same rate that your income is if you hold them long enough. If you trade them, they could be taxed at a different rate. Like I said, I do all this for goodkidstrading.com. I share my trades in real time. I write blogs there. I encourage you all to sign up. And I thank you all for being here tonight. I'm sorry about the technical difficulties. That's all that we have for tonight. I think this was way I look at dividend stocks, and I think it can help you make a lot of money. Passive income. The most passive income I know is to buy some shares of a company and not do anything. Don't have to work. I don't have to run a shovel. I don't have to shovel the dirt. I don't have to run the backhoe. I still get paid. And I think dividend stocks have a place in your portfolio the same way. So visit goodkidstrading.com. I'll see you in Discord tomorrow. I'll see you in just a few minutes in Discord. Have a great night. Thanks for being here. See you next time.